In the name of God, the most merciful, the most beneficent. And this lecture is for CMA Part 2, Chapter B, Corporate Finance, under which this is the fourth section for equity capital, the basics of equity capital. And in this lecture, we will define and find the characteristics of common stocks and preferred stocks. So, as per the learning statement, the learning outcome statement, so define and identify the characteristics of common stock and preferred stock will be learned in this part of the lecture. The equity capital are categorized under long-term sources of finance because legally they are irredeemable in nature. For an investor, these shares are a certificate of ownership in the company by virtue of which investors are entitled to share the net profits and have a residual claim over the assets of the company in the event of liquidation. So we are talking about equity shares, which will be comprised of common stock as well as preferred stock, that we will be discussing in detail. And actually, these stocks, the various characteristics of these equity shares, they will be having a par value, or maybe it can be called as face value, and there will be an issue price and share premium or share at discount, meaning par value it will be slightly more than the par value, then it will be premium, and it can be less than the par value, it will be discount value, and book value and market value. All these things we will be studying in detail one by one. And we are in the equity, we have authorized share capital, issued share capital, subscribed share capital, and then paid up capital, rights share, bonus share, and sweet equity share. All these things are there, and we will see one by one briefly as a short. So the authorized share capital is the maximum amount of capital which a company can issue. The companies can increase it from time to time by adequate complying with the legal formalities and by paying fees to regulatory bodies. Issued share capital, out of the authorized share capital, certain portions, certain amount of shares will be issued to the public, inviting the public to invest on that. So that is called issued capital. Share capital is that part of authorized capital which the company offers to the investors. And the subscribed share capital is the part of issued capital with which an investor accepts and agrees upon. So issued capital are from where the investors are accepting that many number of shares that I want to invest it, so that they are subscribing. And then paid up shares, it's fully or part of issued and subscribed capital which an investor has been allotted and paid. So they subscribe to this many number of shares, and then the company can allot fully or maybe partly for them to accepting their subscription to become shares. So that is the paid up capital. The portion that is paid, if it is partly paid also, the portion that is paid is paid up capital. And what is the right shares? And then we will see what is bonus shares. The right shares are those which a company issues to its existing shareholders. If already they are existing shareholders, whenever the company issues new shares, and they will have the right, they will be allowed first to purchase the new shares. The company issues such kind of shares in order to protect the ownership rights of the existing investor, because they want to protect the rights of the existing investors instead of bringing new investors. So that is the idea of this. First they will offer to the existing investors, and if they are not meeting the need of the organization's capital requirement, it may go to other public. and bonus shares are issued in the form of a dividend to the company's shareholders. So same shareholders, they can pay the dividends in cash, or they can issue like a bonus shares instead of dividend paid in cash. Equity share are issued to exceptional employees or directors of the company for their exceptional job in terms of providing technical know-how or intellectual property rights to the company. So this is like kind of bonus or reward kind of things. So this is the types of equity shares that will be studied, and when we call major category of equity shares, we will be discussing about common equity shares and preferred equity shares that we will be discussing in detail. Now we start defining the equity stock as well as the preferred share stock and some certain specific features of equity stock and preferred share stock. So equity stock, a stock or share, also known as company's equity, is a financial instrument that represents ownership in a company or corporation and represents a proportionate claim on its assets. That means what the company owns, and earnings, what it generates in profit. Actually, students should understand, should be aware that in the CMA US examination, we are concerned with the equity of corporations, particularly the public held corporations, not of a partnership or sole proprietorship. Shareholders who buy stock in a corporation have a claim on the corporation's assets and profits based on the proportional shares of stock owned. For example, if a company has 10,000 shares of stock outstanding and an investor owns 200 of them, the investor owns 2% of the ownership of the company. So that's how we used to understand. Generally, the management of the company comes to the majority of shareholders or the major shareholders. So that is how the company is managed or governed by the majority of the shareholders. Stockholders' claim, however, are subordinate to all debt holders. So that is, they are standing in a last when in case of liquidation of the company, their stake is standing in the last after paying the debts, all the liabilities, the bondholders, and then even profit preferred shareholders, and then only they get the whatever the residual balance available according to the share will be divided and they get it. In addition, common stockholders' claims are subordinate to even preferred stockholders' claims. So that is the last thing. The last two will be preferred stockholders and then the common stockholders. Among these, all the liability holders like debt holders and all will be settled. After that, the preferred stockholders claim will be settled. Then the common stockholders, who are the owners, actual owners, will be taking the last residual balance. Ownership is calculated by dividing the number of shares an investor owns by the total number of shares outstanding. So par value and legal capital, every share has what is called the par value of the share. It can be also called as face value, which is an amount determined by the company issuing the shares. It is also called as a legal capital. It represents the company's legal capital. This is the amount of money that may not be distributed as dividends. So this money, the face value of the stock, cannot be distributed as dividends. Dividends are paid from the equity which are compressed by the retained earning or the current profit after the management discussion. That too also after settling all the due falling maturity at that time, and also settling if there is any claim of the preferred stockholders dividends. So that is one thing. However, in this part of the amount capable of distributing the excess money obtained by the company by selling the shares over the par value. That also, however, any amount that is received by the company for the sale of shares in excess of the par value is able to be distributed by the company. The par value is also the maximum amount of personal liability that a shareholder has in the case of liquidation. What is meaning is that if in case of liquidation, if the problem becomes bankrupt or anything like that, and the company cannot go to the private estate of the shareholders. So whatever they have invested as a share capital, that money can be lost. That's the only thing. For preferred shares, the par value is used to calculate the dividend. So for the preferred shares, like it is a fixed rate of return. So whatever 8%, 12%, whatever it will be calculated on the face value of the shares. The par value of preferred stock is usually 100 per share. So that, for example, if it is an 8% preferred stock, then they will take $8 per share when the date of declaration of the dividend. Market value of a stock. It represents the value of a company according to the stock market. So whatever that share is traded in the market, that value is called the market value of the stock. A stock market value, the last reported sale price for outstanding shares, determines the company's market capitalization. So it is always, volatile, fluctuating depending on the company's value or the market environment. So all these things. So it is based on the systematic risk also, the market conditions. The market value of stock is the price at which a share of stock trades in the public market. Example, in a stock exchange, such as New York Stock Exchange or over the counter through a network of dealers. So market capitalization. Market capitalization is simply taking the number of equity shares and then the current price of the stock. So you get, multiply that, you get that value. So that is called market capitalization. So it is a kind of understanding that how the firm is having a value in the market. So that is what market capitalization formula. Market capitalization is one of many methods used to categorize types of stocks. Stock classification based on capitalization. We can see a large cap, that means the large market capitalization. That is, for example, 15 billion and over, if the value is there, it is called a large cap. And mid cap is between 2 billion and 15 billion. Small cap between 300 million and 2 billion. And anything below $300 million is micro cap. So large cap stocks frequently offer regular dividends because they are, and the underlying company's size generally lessens the risk of company failure. So company failure will be also risk. That is the reason why it is becoming large cap, because the market is in the market, that share is getting good reputation and it is generally and regular dividends will be paid for those shareholders. Mid-cap stock companies offer a greater potential for growth than larger companies, but the risk is also greater. So comparatively to large cap stocks, mid-cap stocks will yield a good return, better return, but risk is also slightly higher than that. And small cap companies have a potential for dramatic growth, sudden growth can be there like that. But they also have potential for greater volatility and therefore the risk. Micro cap is the riskiest group of all, and let us see other common stock types. So precisely to define about the common stock, a stock or share, also known as company's equity, is a financial instrument that represents ownership in a company or corporation and represents a proportionate claim on its assets, what it owns, and earnings, what it generates in profits. A stock or share or equity instrument signifies an ownership position, that means ownership position in a corporation. So common stock gives part of the ownership, potential dividend payments, and preemptive rights. Preemptive rights means that you will be studying in detail. That means if the company is issuing new shares, they will have the first priority to buy those shares. And limited, it has got a limited liability caption. So price appreciation in the market and voting rights, which is a major difference between the common stock and preferred stock. However, when the company does well, so you have good amount of money earning, which is a good return, and if you also risk losing your investment. The rights and expectations of common shareholders. The right to share in the company's profitability and gain from its stock price appreciation. If the price is appreciating, that also will be the beneficial for those common stockholders, not to any bondholders or preferred stockholders. And so that profitability, income, and assets, everything will be shared as the last. If it comes to last residual amount, the benefits of that will be going to the common stockholders only. A degree of control and influence because of their voting rights and other things, company management selection and other things. And right to vote that influence the policies of the company, appoint chief executive officer, right to receive dividends. Okay, when the company perform and when there is sufficient amount to give dividends, the shareholders have right to receive dividends. The right to buy shares of a new issue, that is the preemptive rights that we will be studying. The right to share in the distribution of residual assets, all in case of liquidity. The right to sue for wrongful acts. If the management or anybody having a wrongful act, so you can go to the court, you can sue them. So we continue with the rights and expectations of common shareholders and giving some details like what is meant by preemptive rights. Some common stocks have preemptive rights, right of common shareholders to buy shares of a new issue. If it is given to the shareholders in the company's bylaws, and it has to be given in the company's bylaws, this preemptive right allows the shareholders to purchase the same percentage of newly issued shares that they currently own. If a shareholder have 2% of the total issued shares, so when the new issue comes, he have the right to buy up to 2% of the new issues. So that is the, if it is mentioned in the bylaw. Okay, so this is the preemptive rights. So that means they can have the proportionate ownership of the company, still they can continue to maintain. Preemptive right is merely a right and not the obligation that the shareholders must purchase new issue. It doesn't mean that any shareholders must buy the new issues. They have the right only, not obligation. Okay, the right may not always be given, but it is becoming more common. So commonly it is given. This right prevents the ownership share of a shareholder from being automatically diluted because of the issuance of new shares. So the ownership cannot go to different hands if properly all the majority shareholders are exercising their rights. As if they think it is not obligatory and they don't buy, and if the ownership right goes to other shareholder because of the new issue, that is different matter altogether. The right to receive dividends. The common dividends are declared. Common dividends may or may not be paid in a given year. However, if they are declared, all common shareholders have the right to receive the dividend. Those shareholders are not guaranteed dividends like preferred shareholders, cumulative preference shareholders. The right to receive dividends is one of the rights of a shareholder. The right to share in the distribution of residual assets. So, as we saw that if a company is liquidated, common shareholders will receive a distribution of whatever assets are left after all creditors have been paid in full. That is after bondholders, other debt holders, and after preferred stockholders are paid in full. Then that will be there. The losses are limited to the par or stated value of the stock. So the private estate cannot be claimed. Comparatively, preferred stock generally offers a fixed dividend. The dividend amount does not fluctuate based on earnings. So company is performing well. So if it is a 8% preferred stock, it will not be like increase to 9 or 10%. So it will be remain 8% only. Even if the company is slightly not performing well, if the dividend has to be declared, it has to be on 8% only, provided that they have fund and all. Otherwise, if it is a cumulative preference shares, so it will be continued in the next period. The term preferred also implies that shareholders have a right to receive their specified dividend before common stockholders are paid and any dividends. A fixed dividend reduces investors' risk because it also limits financial rewards. One side, so it is the risk, so the return is fixed so that the investors are happy, and the expenses, the dividend expenses is limited or fixed so that the company issuing that is happy. Preferred stock has less volatility when markets fall because it is having a fixed income return, so it is less volatile when the market falls. But shareholders cannot count on large price gains in rising markets, so they cannot count on that because it will go to common equity holders. In fact, the dividend is not guaranteed also. The board of directors which votes on dividend issues does not have to pay the fixed dividend if it so chooses. If the board, because the preferred stockholders have no voting rights, common stockholders have voting rights, and if they choose, even if the company is getting profit on that particular year, but due to some valid reason, cash flow, other reasons, if they choose not to give dividends on that year, they can postpone it, or they don't need to give any dividend, declare any dividend. And it will be in the subsequent year, provided if there is a sufficient equity fund available for distribution of dividends, and also the preferred stock is kind of cumulative stock. And actually, preferred stock is a hybrid or cross between common stock and bonds. There are similarities between bond and preferred stock. So preferred stockholders usually do not vote on issues like bondholders also. Preferred stock usually pays or earns a constant annual dividend, and preferred shareholders receive preference over common shareholders, like bondholders also have preference over shareholders. Preferred stockholders generally receive dividends before common stockholders like bondholders. In fact, bondholders receive their return even before the preferred stockholders, and often preferred stocks are issued with bond-like features like callable, convertible, having a maturity date, and requiring a sinking fund, etc. So preferred stock is similar to common stock in the following ways: not paying preferred dividends during times of financial distress, does not breach a contract and cannot result in bankruptcy proceedings. Like if bondholders are not paid, they can trigger the bankruptcy procedures and they have certain rights on that way. But preferred stockholders cannot do that way. If during financial distress, if the company does not pay, it does not breach a contract and cannot result in bankruptcy proceeding. Preferred dividends are paid after interest and taxes only. Like common stockholders also paid dividends after interest and taxes and after paying to the preferred stockholders, if any due. In the event of asset distribution in a liquidation, preferred shareholders are junior to the bondholders and other creditors, similar to the common stockholders. But they are senior to common shareholder in a liquidation and will receive money before common shareholders receive. Other characteristics of preferred stock. So characteristics are set out in the share document themselves also. We can see that whether it is a cumulative shareholder or callable, preferred, and all these things will be set out in the documents. So it is possible that not all these characteristics will exist in every situation. What is meant by cumulative dividends? Or dividends that are earned every year by the preferred share. Okay, that means dividend is only earned every year but does not need to be paid every year. That is the idea of that. Because in a year, if the cumulative dividend is not paid in a particular year, it accumulates and it must be paid in the future before any common dividends may be paid. The dividend for cumulative shares, as generally with all preferred shares, is a set percentage of par value. If the preferred dividends are not cumulative, any dividend that is not paid in a period of period is lost and will not be collectible in future periods. And callable preferred shares can be repurchased by the issuing company in accordance with the call provisions. There can be a set price or a specific time period after or during which the shares may be repurchased. So this is like bond also. Convertible preferred shares are preferred shares that give the owner the option of converting the preferred shares into common shares. Again, there may be limits on when this can be done or how many shares can be converted during a time period. Preferred shareholder may convert his shares in order to be able to vote. So they will be willing to convert it when it is available. Participating preferred shares can receive additional dividends in a year when the company achieves a particularly high profits. This is one of the difference among the commonality of the preferred stock. Participating preferred stocks. Unlike a fixed dividend, they can also have some shares of the if the company achieve high profits. This is usually done by having the preferred shares participate in the common dividend after receiving the preferred dividend. The preferred shares may receive a full share of the profits distributed if they were a common share, or they may receive only part of the common distribution. So that is the slight difference between the other characteristics of the preferred stockholders. Redeemable preferred shares can be redeemed at the option of the shareholder. A shareholder can essentially force the company to repurchase redeemable preferred shares if they choose. So it will be redeemable option will be there after certain date. So they can force the company to buy back. Or if they prefer to keep it, they can keep it. So that is the redeemable preferred shares. And liquidating value. In the event of default or bankruptcy, preferred stockholders have a claim on the company's assets ahead of common stockholders. Should asset liquidation take place, preferred stockholders are paid only after short and long-term debt holder claims are satisfied. Okay. And another characteristics is that comparatively to the bond, and it is interest based, so it is tax deductible. But here preferred stock shareholders dividend is not tax deductible. So this is the summary statement. You can see this convertible and non-convertible. So convertible shares possess an option or right whereby they can be converted into an ordinary equity shares at some agreed terms and conditions. Non-convertible cannot be done. And redeemable and irredeemable, we have seen just seen. And participating and non-participating, you can take this summary note for that. Cumulative and non-cumulative, and shares with callable options. The main advantages of issuing preferred shares are for the company which is issuing the shares, or that the voting control of the company is not diluted from the common stockholders, okay, especially the majority of stockholders who have the voting rights. So that will not be diluted, and in most cases any unusually high profits are maintained for the common shareholders rather than needing to be distributed as a dividend to preferred stockholders. However, the disadvantages of issuing preferred stock are that the dividends are not tax deductible, unlike bonds. So because the return is fixed, so instead of giving like a preferred stockholders, so if it is a bond, so it is tax deductible. So that is a kind of disadvantages. But there are other plus and minus that we can study in detail. Okay, and in the case of cumulative dividends, there is still a need to pay dividends. So it is a must-pay situation that we have seen earlier also. Even when the income is low, we need not pay the dividend, but in the subsequent year, when the profit becomes better, and the dividends has to be paid in a cumulative manner before giving dividends to the common stockholders. So that is the situation of that. So blue chip stocks, they are the largest and most consistently profitable publicly traded companies which are having a very high reputation. So this equity capitals trading in the market will be high also and larger portion of the market. And growth stocks are of corporations that have a strong growth potential with sales, earnings, and market share growing faster than overall economy. So that is also growth potential. In the stock market, if you are trading, you will know all these things talk and even in the list of suggestions, recommendations, and they give categorize the shares and accordingly they give the recommendations. Cyclical stocks are of corporations whose earnings are highly dependent on economic conditions. Upturns or slowdowns and all this. And defensive stocks are conservative stocks that are relatively stable and impervious to most economic conditions. Other common stock classification, you have also value stocks or stocks that appear inexpensive when compared to earnings and other performance measures. These are short notes that will be useful for your answering certain multiple choice question also. So you should understand that way. Income stocks are stocks of typically solid performers with good track records that usually generate a steady dividend income stream. And speculative stocks are risky investments in corporations that have yet to prove their true worth. Actually, whenever we talk about voting rights, we always mean the common shareholders' voting rights, unless we speak specifically mentioning about preferred shareholders' voting rights. So, in such a case that we explained earlier. So, the ownership of common stock gives shareholders the right to vote on important company matters, such as what are the things that the election of members of the corporate board of directors to oversee the company management on behalf of the shareholders. So policies and changes in corporate bylaws, approval of stock option plans, mergers and acquisitions, and appointment of auditors. External auditors has to be appointed for companies. So this also will be selected by the board of directors. And shareholders typically get one vote for each share of stock owned. So that many number of stocks they will have that many number of votes. Companies administer voting rights in one of two methods. One is traditional or cumulative voting. That means the cumulative voting through proxies and traditional voting, and we will be discussing now in little further detail. And these voting rights can be through proxies. Shareholders are able to give their vote to someone else to vote. So that is called proxies. So we will see that in what is traditional voting. Traditional voting is known as majority voting, majority rule voting, or statutory voting. So these are the common terms. It is a corporate voting system in which shareholders voting for the board of directors are limited to one vote per share. So how many number of shares you have, that many number of votes you can have. So that is called traditional voting, majority voting. The total number of votes for each stakeholder equals the number of shares owned times the number of positions open. This we will see with some example. Example, in an election in which 5 directors candidates are running for open board positions. Okay, 5 board of directors positions are vacant, so they are standing for election. So you have each vote will have 5 votes for each director per share. So that means the shareholders, for example, if a shareholder owning 500 shares could cast 500 votes for each candidate for a total of 2500 votes. That means because there is 5 directors, so 5 times multiplied by the number of shares that the voter has, the shareholder has. So therefore it is 2500 votes, which he can, for each director they can cast 500 votes. The traditional majority method of voting precludes minority interest from electing any of their own minority candidates. So because of this case, because the shareholders who have major vote sharing, so they will protect their interest. So minority votes are affecting those who are having lesser number of voting rights. As opposite to traditional voting, cumulative voting system allows shareholders to cast different number of votes for different candidates. Taking the same example, we can understand that. So continue with the same example. 5 directors position, the shareholder owning 500 shares could distribute the votes equally to the 5 candidates, that is in the traditional system, but distribute the votes among some combination of the candidates or cast all 2500 votes for a single candidate. So this is called cumulative voting. So if they have total 500 votes multiplied by 5 board of directors position, so they have totally 2500 votes which they can give cast for one particular candidate, at least to guarantee that even a minority members can think of that way, so that they can at least bring one of the director to represent them. So this is the advantage. This cumulative voting system gives minority shareholders more voice in corporate governance by increasing the chance to elect a certain number of directors. Some corporations issue different classes of stocks with different voting rights. In such situations, a class of shareholders is allowed extra voting rights. A small group of individuals could control the directors of the corporation while owning less than a majority of shares. Shareholders can cast their votes by mail using a proxy statement. By nowadays, like it can be through internet websites, a portal, or email, it can be casted, or even by telephone, internet, some kind of voice mail options are there, so they can cast their vote. A proxy statement is a legal document which can be submitted for authorizing someone else to vote on the investors. Okay, let's see the common share capital and preferred share capital together side by side, and we try to understand the meaning and with some differences also. The stock or share generally called as a company's equity or common stock. So under common share capital. It is a financial instrument that represents ownership in a company or corporation and represents a proportionate claim on its assets, the company's assets, what the company owns, and the company's earnings. So they have a claim. This is the case of common share capital. Whereas in preferred share capital, it is just preference shares, that means preferred stock or company stock with dividends that are paid in fixed percentage of the par value of the shares. That will be paid to shareholders before common stock dividends are paid out. Therefore, it is called as preferred. So they have preference over these common stock holders, and also there will be a fixed income will be paid for as a dividend on their face value. But only condition is that if the income is there, then only the dividends will be paid. Unlike bond will be direct, it will be interest will be bond, even if it is profit or loss, the interest has to be paid. But here it is not like that. That is one thing. But there are some other characteristics of these preferred shares based on types of preferred shares, where the income is also kind of guaranteed. So there are 4 types of preferred stock which we will be studying in detail. One is that cumulative or guaranteed preference shares, non-cumulative, and participating and convertible preference shares. So preference shares are ideal for risk-averse investors and they are callable. The issuer can redeem them at any time. So that's why there are a lot of benefits, features that give the risk-averse attitude investors go for preference shares. So there are certain common features between common share capital and preferred share capital, both are equity, financial instruments by nature, and both types of stock represent a piece of ownership in the company, though it is not exactly the similar pattern, like common stock standing in the last resort, to have a claim, but preferred stock have preference over the common stockholder. That we will see in a distinction. But from the ownership point of view, they have kind of though preferred share capital, they don't have the shareholders, they don't have voting rights like owners to make decision making, but they have kind of ownership uh, feeling in the company assets. So that is there. Both types are tools of investors, that means financial instruments that can be used to try to profit from the future success of the business. So they go for equity stock, unlike bonds, so they can go for preferred share or common stock. So slight difference is also there. The return is more in the common stock and less in the preferred stock. At the same time, it is kind of guaranteed than the common stock return, and the risk is lesser than the common stock equity return. So these kind of differences, of course, are there, but both, like preferred by the investors, kind of for making profit from the future success of the business. Both have same characteristics of equity-based financial instruments. That means like issued by company, authorized capital, paid up capital, and all these things, capital financing, and par value or face value of the shares, and number of shares to be issued, and these things have similar characteristics for both. However, common stock has no such kind of guaranteed rate of return like preference shares, like dividend percentage of dividends on the face value, or bond like fixed interest. Whereas preferred stock has characteristics of both two involved, like bonds as well as common stock. Okay, so therefore it enhances its appeal to certain investors. Certain investors who they don't want to take too much risk, like completely like common stock equity, and too much risk covers like bond, secured bond or something like that. So they want to get little better return in between. So for them it is better choice. And both common share capital and preferred share capital have claim on the distribution of company's income, that is dividends. They have claim, but with some distinction features based on their capital percentage or the uh, agreement by way of the share certificate. Certain distinction like lower claim than preference shareholders. So common stock shareholders can have lower prices because they stand in the last priority. Okay, higher claim than common shareholders. So they are also last in priority compared to any bondholders, debtors, and all, but they will be standing in a superior priority than the common shareholders. So in the event of liquidation, both common and preference stockholders are last in line when it comes to company assets. So they are last in line. After settling the other claims, then only they come, which means they will be paid out after creditors, bondholders paid. So that is the idea. And after paying the creditors, bondholders, preferred shareholders will have the higher claim than the common shareholder. After settling the preferred shareholders at the last in line, even after the preferred shareholders' claims are settled, the residual value, if any, will go to common share capital holders. So voting rights. So there is a clear difference in the voting rights aspects. So common shareholders, it confer voting rights. Okay, but whereas in preferred share capital, there is no voting rights. So investors most often get one vote per share, want to elect board members who oversee the major decision made by the management. So common shareholders have the voting rights, so therefore they will be able to control the management decision making, the board of directors, all these things. Whereas the preferred shareholders have no voice in the policy, direction, control and future of the company because they don't have voting rights. That's all. Thus, it gives the ability to, for the common share capital, it gives the ability to exercise control over corporate policy and management issues compared to preferred shareholders. But in the preferred shareholder, however, Some preferred shareholders also have the right to vote. It is a common feature that preferred shares with cumulative dividends automatically receive a voting right. We will see what is in detail about what is cumulative rights of preferred shareholders, but it is something like we can understand basically. If in a year, if there is no profit, or if the board of directors decide not to give any dividends, they may not give dividends even to the preferred shareholders. But if the shares are like cumulative, it means the following year or the next year, whenever that they declare the dividend, first they have to cumulatively pay for all the previous years their shares due to the preferred stockholders. That's the meaning. So in such case, whenever there is no the annual general meeting happens, so the preferred shareholders will have a voting right. Okay, so that is the idea, because their interest is affected, so therefore they will have voting right on such cases, such occasion. So we again go with little more details of comparing the common stock and preferred stock. So common stock provides equity ownership in a company that we have studied, but the common stockholders are last in line. That also we have seen. They are last in line when it comes to company assets, which means they will be paid out after creditors, bondholders, and preferred shareholders. Whereas preferred stockholders have a priority over a company's income, meaning they are paid dividends before common shareholders. In the types of stock in which most people invest is in basically the common stock. Next to that, only the preferred stock, relatively lesser in number. Generally, stock means common stock. Common stock are biggest potential for long-term gains. If a company does well, the value of a common stock can go up. But if it does poorly, the common stock value will also go down. In a liquidation, the common shareholders are the last in line, that we know that. Owners of preference shares receive fixed dividends well before common shareholders. The preferred shareholders, though they are standing last in line, but they will see before even the common shareholders see any money. So once a struggling business finally rebounds and is back in the black, those unpaid dividends are remitted to preferred shareholders before any dividends can be paid to common shareholders. So even in liquidation, preferred stockholders have a greater claim to a company's assets and earnings. CME adopted question. One reason that a financial manager may prefer to issue preferred stock rather than the debt is because. This question is giving 4 reasons or options, which is the right reason that why the financial manager decide to issue preferred stock compared to debt issue, bond issue. So let's analyze the first option. The cost of fixed debt is less expensive since it is tax deductible, even if a sinking fund is required to retire the debt. So if we take this reason A, and this reason will give the idea to the finance manager to issue bond, not preferred stock, because the cost of fixed debt is less expensive. So that is not the right answer for this. So second, the preferred dividend is often cumulative, whereas interest payments are not. So this is also for the financial manager, it will not be preferred, because for the company point of view, a cumulative dividend is more risky. Okay, so that is there. Okay, and because he is giving kind of equity right plus kind of bond right also, like cumulative dividends. So that is also not attractive for the company finance manager. So third option, payments to preferred stockholders are not considered fixed payments. So this also not true, because of the concept, the understanding that preferred stockholders payments will be like a fixed payments, like a percentage of the face value. So option D is the right choice. In a legal sense, preferred stock is equity, therefore dividend payments are not legal obligations. Failure to pay dividends on preferred stock will not lead to default. So that is the main part here. In the option D, it says in a legal sense, preferred stock is equity. It is considered that. Therefore, dividend payments are not legal obligations. Whereas failure to pay interest on debt may be triggering the legal obligation. So that is the main reason that the finance manager considering issuing preferred stock comparing to debt issue. CME adopted question. Which one of the following statements is correct regarding the effect preferred stock has on a company? So the effect of the preferred stock on a company. So option A, the firm's after-tax profits are shared equally by common and preferred shareholders, which is not the after-tax profits are not equally to the common shareholders and preferred stockholders. So it is a wrong answer. And B, control of the firm is now shared by the common and preferred shareholders, with preferred shareholders having greater control, which is not true because they don't have even voting rights. So B is not correct answer. Preferred shareholders' claims take precedence over the claims of common shareholders in the event of liquidation. So that is one valid point. And if we can see the option D, non-payment of preferred dividends places the firm in default. So this is not true because only if the bond holders do not receive any dividend, interest on bond, so then they can sue for the claiming for the non-payment, and they can sue for a default case. But for the preferred dividend, they are equity holders also, and they cannot sue for default case. Okay, so option is correct because preferred shareholders' claims take precedence over the claims of common shareholders in the event of liquidation. Thank you. So we will continue the next lecture about valuation of equity, that is valuation of common stock and preference stock. And valuation of bonds we have already seen covered in that earlier lectures. So this by this we complete the section 2 of long-term financial management. And just before completing this, and we will have to see the derivatives part also, that will be also given in the subsequent lecture of after continuing the second lecture, and it will be the third one. And this is the fourth lecture on chapter